I think it is clear to believe in the power of ideas.
Fresh thinking to the Manhattan Institute.
Okay, our second session is three papers with Charlie Calomiris, Peter Ireland, and Marvin Goodfriend. They're each going to take about 10 minutes, and then we'll have a little Q&A. Okay, we're running up against a constraint for lunch, and then we've got Esther George coming. Okay, so Charlie, you go.
Thanks, Mike. Well, you know, the Shadow Open Market Committee is always saying that policymakers should look ahead. And what I want to point out is that if we were going to look ahead, what we would say is 5 years from now, the main concern we'll have about the lack of credibility and confusion that's going to be developing about monetary policy is coming from something that really has never occurred before. If you haven't been following it over the past 3 years, there's been a call to arms among central bankers and policymakers at multilateral institutions like the Basel Committee and the IMF, the European Systemic Risk Board, in favor of something called macroprudential policy. Macroprudential policy is grounded in the economics of something called the financial accelerator. So I'm sorry to use all this jargon, but it's important, and you're going to be hearing a lot more about it. And I will predict that it's going to be a major source of confusion to the world about what central banks are up to. The idea for macroprudential policy was inspired largely by the perception that the absence of macroprudential policy tools in this last boom and bust was absolutely critical to the policy failures that happened, and that therefore we need to create very aggressive policies in macroprudential to prevent repeats of these sorts of problems. So I want to emphasize, what is this macroprudential idea? It's basically saying that capital requirements or liquidity requirements or mortgage leverage limits or other kinds of what we would normally think of as microeconomic prudential tools should vary over the cycle as part of a sort of fine-tuned management of financial exposures, the health of the balance sheets of consumers, firms, and banks, and the incentives of banks to lend. So we're going to start monkeying with all of these different microeconomic levers as new countercyclical policy tools in order to influence the balance sheets and incentives for borrowing and lending of firms and banks and consumers. And this is grounded in, I think, some pretty good research. That is, the research of the financial accelerator I've been supporting for 30 years. I think I've been a big part of it, or at least a small part of it as a person, of the movement saying that these balance sheet effects really matter. In other words, we have a lot of evidence telling us that these tools qualitatively would have effects, and that they would have effects on the macroeconomy too. So I want to be very clear. These tools, I will not be arguing, are useless. They're quite powerful. But there are some major problems, and in my view, the biggest threat to medium-term monetary policy is going to come from the application of these tools. This is no longer hypothetical. The Basel system has already adopted this notion. Most of the major countries, certainly the G7, have adopted it, and we are about to experience it. Now the idea is, if we do it, we're going to be able to fine-tune all of these balance sheets and borrowing and lending incentives so that we will avoid financial booms and busts. But I think actually there are other unintended consequences that we need to take very seriously and that should be very sobering. And at the end of my talk, and I know I don't have forever to do it, Mike, I got your hint, I'm going to talk about what I think might be a middle ground that would cede a little bit of the logic to the macroprudential policy advocates while avoiding most of the damage. So this is my attempt to think far ahead of the curve to try to say what we could do to get most of the benefits advocates are talking about without huge unintended consequences. So what are these 4 unintended consequences? The first one is related to taking our eye off of the ball. That is, macroeconomic prudential regulation is all based on the notion that the problems that we had were just the result of forces that normal good policy can't deal with. And I think that's wrong. That is, if microprudential regulation of banks had been effective and credible, if we had had real constraints on bank risk-taking, I don't think that we would have seen the need for an extra sort of adjustment. And furthermore, if we had been following a monetary policy rule, particularly from 2002 to 2005, that wasn't heating up the system, we wouldn't have experienced the kind of boom and bust cycle that we did. So the diagnosis, part of the problem here is the diagnosis is wrong. It's claiming that, in general, good microprudential policies, on average, that is constantly held but effective, and effective monetary policy aren't enough. I think that that's most of the time, let's say 95% of the time, that isn't true. And so I think the diagnosis is wrong. Secondly, the notion that you want to, during recessions, weaken prudential policy in order to boost lending, well, we've been doing that for the past 30 years. It's called forbearance. And it's been proven to be a disastrous policy. When you weaken prudential regulation during recessions to try to prop up lending, what you get is more severe recessions eventually, because you get credit busts coming from massive insolvency of the financial sector. That's not a hypothetical. That is the reality of the past 30 years. So applying macroprudential policies during recessions to try to prop up the cycle has already been demonstrated to be a disaster. Third, do we know what the size of these effects are that we're thinking about manipulating? Well, there are only 2 countries where we can really get a reasonable econometric handle on this, and they are the UK and Spain. And that's because of their history with varying, in the UK, capital requirements, and in Spain, varying provisioning requirements, so that we have enough panel variation in the data to have some notion of what capital requirements do. And without bragging, I would say I'm part of the team of people who we now have 3 papers coming out looking at the UK evidence in the Journal of Financial Economics, the Journal of Money, Credit, and Banking, and in Economic Policy. So let me tell you what I think we know. First of all, the effects are very large. If you increase capital requirements from about a 10% average to an 11% point, increasing them by 1 percentage point, your lending to the non-financial sector would fall by about 7%. In other words, the elasticity of supply of lending with respect to capital requirement changes is about 0.7, negative 0.7. That's very big. But it varies a lot according to the bank circumstances and other circumstances that we're finding. That's why we have more than 1 paper coming out of it, because it turns out that that number on average obscures as much as it informs, because there's huge variation in the effects. In Spain, the evidence from provisioning requirements is about an elasticity of negative 0.3, which makes sense because provisioning, $1 of provisioning is probably, it's a front loading of capital, about 50 cents of capital. So the 2 countries are giving us similar numbers. But what they're really telling us when we look at the variation in these effects across banks and across time is that what we have, of course, is a bazooka, not a pea shooter. This is a very big, potentially large effect, but it's a bazooka without a sight. That is, we don't really know enough about the values of these elasticities over the cycle and across banks so that we can apply them confidently to other countries. In other words, to apply the logic of Bill Brainerd's classic 1967 article, we should be very worried about aggressively pursuing these policies. Now, the final point, which I would say is perhaps the most important one, is what would this kind of use of multiple tools, remember we're talking about varying leverage requirements for mortgages, varying capital requirements for banks, varying liquidity requirements for banks, and many, many more things. Over the cycle, let's say 5 or 10 different tools potentially, alongside monetary policy as part of a desired achievement of countercyclical policy. What is that going to do to monetary policy and to central bank accountability, credibility? And I think the answer is potentially disastrous consequences. And the consequences are of two kinds. First, note that monetary policy for most of Fed history, as Alan Meltzer has shown, has been pro-cyclical. And what people point out there, especially Alan, is that there have been two problems that have produced this pro-cyclical bias. One of them is macroeconomic modeling fads. In other words, beliefs in models and using them on a discretionary basis that have turned out to be false. And the other one has been political capture. Those are the reasons why monetary policy has been pro-cyclical. What is the cure? Well, the cure is you have to establish some sort of rule. What a rule does, let's take a Taylor rule, for example, is that it limits the discretionary fadism on the one hand, and secondly, because it creates a clear rule, it insulates policymakers from political capture. So rules are extremely important. What will macroprudential policy do to the ability to establish rules? Two horrible things. First of all, the rules are based on econometric evidence from the past about the relationship between the Fed funds rate and unemployment and inflation. When you start having other macroeconomic policies that are varying, I'll only need 1 minute, thanks. Other macroeconomic policies of a prudential kind that are also varying, how good are our Taylor rule estimates? I would say pretty useless. Furthermore, what kind of accountability can we have for monetary policy or for other policies when we can't even specify what our rule is? If you have 5 different tools all operating sort of learning by doing, what's that going to do to the accountability of the monetary authority? And what's that going to do to countercyclical policies accountability more broadly? So my answer is, I've now just listed 4 reasons why we should be very concerned about the brave new world of macroprudential policy. What do I think do the advocates have a point? And this is, I'll close with this. The advocates do have a point. The clearest example is to look at Columbia from 2006 to 2008. The country, not the university. Columbia is a very well microprudential regulated banking system. I will not have time to explain how I know that, but I'm confident of that not just as a personal judgment, but as a matter of empirical evidence. Furthermore, it's been following a pretty good monetary policy rule during that period, and yet Columbia experienced credit growth in its banking system that kept accelerating up to 30% a year rate of growth. They raised the interest rate 4 percentage points, trying to use monetary policy to try to bring the overheating of their credit system. By the way, inflation was accelerating, other things were happening. Current account deficit was 3.5% of GDP. And they were not getting any traction out of the increase in monetary policy. So they raised capital requirements more than 5 percentage points, raised liquidity requirements, raised provisioning requirements, and put new reserve requirements on short-term capital inflows. They brought the lending growth down to about 12 or 13%. They got a soft landing in their economy without a recession. So I think to make a long story short, that story has other versions of it too. There's other evidence that in some extreme circumstances, particularly for small open economies, but I would say also potentially in the United States, that using capital requirement increases, so I'm speaking asymmetrically here, during booms where you get beyond a certain level of credit growth, let's say 20% credit growth on an annualized basis for more than 18 months, you should have a pre-specified increase in capital requirements in mind to try to get traction, let's say 50 basis points a quarter until the credit growth slows. That's my proposal. But I put it out there as an example, not as a definitive proposal. But my point is, there are ways to create very selective, very occasional use in extreme circumstances of these microprudential tools for macroprudential purposes without undermining, for those 4 reasons I mentioned, all of the credibility of central bank policy. And I think this is really the challenge that we have to be facing. Thank you for your attention.
So we have time for some questions. There's one back there. Yeah. No, that. Oh. All right.
So you've cited examples of Bolivia, Spain, the UK. All these are relatively small economies compared to the United States. Likewise, when in the earlier talks we talked about housing, as if housing in the United States was one representative housing agent. When in fact there are enormous variations both in housing and in regional economies and so forth. What would you think about some kind of prudential regulations undertaken at a more decentralized level within the United States? Would you, rather than have a macroprudential rule for the economy as a whole, what if you went back to the original structure of the Fed and had the regional Feds do their thing?
You know, it's an interesting idea, and Amar, can always depend on you to come up with surprising questions. I mean, I think that we're not in a position right now where that's a realistic policy option of sort of decentralized authority. But I do think it would be a very confusing thing. And I wouldn't, if I were put in charge of one of those decentralized authorities, I wouldn't want to be implementing the policy very aggressively. So I'm not a keen advocate of the aggressive implementation of policy based on very little evidence of what its effects are. So I think that that's, before we learn a lot more, and it's hard to learn much about this policy without doing it. That's the hard part. Until we learn a lot more about what these parameters are, I'm very skeptical of their use, and I do think that there's this other huge unintended cost, which is confusing everyone about how to do cyclical policy through more traditional means. So I'm pretty negative on it, except in extreme circumstances.
So I'd say until 1980 we had an extreme version of decentralized policy where each bank had its own capital requirements negotiated by a banking. So it's not like it's utterly revolutionary.
But they weren't varying cyclically. So and that's the key issue. I mean, it's one thing to have whatever the world's structure is, to have that structure be, you know, sort of constant, and it's another thing to have 100 reaction functions, none of which is well specified, all happening simultaneously, which is, I think, potentially very confusing. That's my view anyway. Yeah.
We're going to take one more question. Over there.
I have a question about, or 2 questions, one about Spain, another about New Zealand. Spain, I don't know a whole lot about, but I'm under the impression that they were on the forefront of progressive banking policy, having developed dynamic provisioning and you know, it maybe in a larger sense having the government run a large budget surplus before 2007. So I'm wondering what you think if they should have just done more of that, and then what the effect is of just prices going down a lot on you know, this sort of policy, and do capital requirements mean anything when banks don't have to mark their mortgages appropriately? My second, which I take to be the case in Spain. My second question is, do you have an opinion on what Governor Wheeler is doing in New Zealand to change capital requirements to try and stem what he takes to be a housing bubble?
Let me answer them in reverse order. I don't have an opinion about New Zealand because I just haven't studied it well enough. But to apply my rule, which is also, you know, buttressed by a lot of evidence, not just about Colombia, but more generally for, let's say, 30 or 40 countries in the world, that this notion that when credit growth is, let's say, in excess of an annualized rate of 20 or 25% a year, that is a serious problem that is really best addressed with capital requirement increases. I think that there's some basis for that view coming from econometric analysis. So yes, if that's what he's doing, and I have to admit I don't know, I'm for it. I also think that your question about capital requirements is very apt. That is, if we're not measuring loan loss properly, and if capital requirements are just a sham because we're not really measuring capital accurately, then capital requirements aren't going to be a very good tool. And so I actually have some other policy proposals I won't go into relating to how to strengthen the legitimacy of the measurement of capital requirements. And finally, talking about Spain, your first question. So yes, it's true that Spain was the intellectual leader in this area, but it's also true that the cyclical variation in provisioning requirements was pretty small. And in fact, Colombia, while it was not the intellectual leader, if you think about increasing in the course of a few months the capital requirements in your banking system by 5 percentage points, that is sort of more than an order of magnitude of what the Spanish did. And there were other countries in Latin America that were also applying this fairly aggressively. So I think that Spain is definitely an intellectual leader here. The evidence shows that was helpful. But of course, the problem was that the cajas were growing the credit, and particularly credit that was being pushed, particularly coming from wholesale funding, particularly pushed into mortgage markets, driving credit growth up in Spain single-handedly, and also driving up real estate prices. And that's a nexus that's very common in these empirical analyses of the reasons for macroprudential interventions. So I'm hesitant to talk about any macroprudential policy, but I certainly recognize that there's a legitimate intellectual point to be made for doing something in extreme circumstances like Spain in the 2000s and possibly, and also Colombia in the mid-2000s.
Okay, Charlie.
I should stop.
Thank you.
Thanks.
Okay, so now our next speaker is Peter Ireland.
All right. Well, like all of my colleagues on the Shadow Open Market Committee, and like many others here in this room today, I would guess, I'm concerned that the United States has entered a new and possibly prolonged episode of monetary instability. Maybe more so than many others, however. I've been worried mainly, at least up until recently, about the possibility that the Federal Reserve could miss hitting its 2% inflation target on the downside, allowing inflation to come in consistently below 2%, maybe even allowing for a renewed episode of outright price deflation, as opposed to missing above target and creating excessive inflation. And some of that concern comes from work that I've done with Michael Bologna, in which we've taken a look at the behavior of the monetary aggregates, M1, M2, and MZM, both in their familiar simple sum forms and our own preferred divisia formats. Regardless of which of those measures of the money stock you look at, what you see if you look at the data is that the enormous increase in bank reserves and the monetary base that the Federal Reserve has engineered since 2008 with repeated waves of quantitative easing, it just hasn't translated reliably or consistently into a sustained increase in broader measures of money growth. And as a matter of fact, when you look at the data over this period, you see that more often than not, money growth seems too slow, not too fast. And then when you couple that with money demand dynamics, the increase, probably sizable increase, in the demand for safe and highly liquid assets during the financial crisis and the aftermath. What that adds up to are monetary conditions that have sent pretty severe deflationary impulses running through the American economy. Towards the end of the paper, at the end of the paper that I prepared for this meeting, I show some graphs of some of these monetary aggregates. And if you look at the pictures, what you see, for example, is that divisia M1 growth peaked in 2005 and began to decelerate. And that monetary deceleration continued unrelentingly, even as the economy weakened in 2007 and fell into an outright recession in 2008. Money growth bounced back after that, but then fell down once again and was anemic during 2010 and the first part of 2011. So those graphs and the correlations that they imply don't prove that tight monetary policy was the cause of the Great Recession or the sluggish recovery that we've had since then. But on the other hand, when you think about the inflation that we've seen lately, coming in below 2%, the 2% target now for more than a year, and you look at those graphs, they at least make you wonder, could the low inflation that we're seeing today have something to do with slow money growth observed 2 to 3 years ago? Now, more recently, there's actually been some much better news. Monetary aggregates as a group began growing more rapidly towards the end of 2011, and they've stabilized since then at growth rates that look much healthier. And in the meantime, the money demand dynamics that I mentioned previously have probably already begun to reverse themselves, with people shifting out of monetary assets and into riskier but higher yielding alternatives. And so what you have today is a money supply curve that's shifting to the right and a money demand curve that's shifting back to the left. And that's produced monetary conditions that are much more supportive of a strengthening economic recovery and much more supportive of a return in inflation back to the 2% inflation target than we've seen in the United States in quite some time. So I have sympathy for people on the FOMC who look at low inflation today and say, well, I'm worried that monetary policy is too tight. But when you look at the monetary aggregates, you get the added nuance. Low inflation today, I think, is probably more symptomatic of monetary policy that was too tight 2 years ago than it is systematic of a monetary policy that's too tight today. Now, in the paper, I also talk a little bit about interest rates. I wasn't going to bring that part up today, but now I have to in light of what we heard 2 days ago from the FOMC. With the federal funds rate stuck at its lower bound of 0, everybody's attention has focused on long rates as indicators of monetary policy. And we heard the consensus view on that with the policy announcement earlier this week. The idea is if you see long-term rates fall, that's taken as evidence that the Fed Reserve's unconventional policy tactics are providing additional stimulus. And if you see interest rates going back up, that's taken as evidence of the opposite, that the Fed has to do more. But Milton Friedman warned us a long time ago about the dangers in using interest rates as indicators of monetary policy. And recent work in the area of financial economics has underscored the problems that Friedman spoke about and added nuances that are useful in thinking about the situation today. What recent work in the area of financial economics tells us is that long-term nominal bond rates not only depend on expected inflation in the future, they depend on the whole distribution of what future inflation is expected to be. And they depend in particular on the way that inflation co-varies with what people younger than me would call the stochastic discount factor, people maybe a little older than me would call the market return, but which I just like to think about as real economic activity. The idea is this. If bond traders perceive that there's a non-negligible chance that the Federal Reserve would allow the price level to decline on a sustained basis during a severe economic downturn, that makes nominal bonds act like an insurance policy. The deflation raises the real return on nominal bonds during a recession exactly when you need it most because income is falling and every other asset is paying off a bad rate of return. And what recent work in financial economics tells us is that under those circumstances, the risk premium that's typically built into bond prices, whereby interest rates have to be higher than they would otherwise be in order to compensate investors for inflation risk, it not only shrinks, but it can actually flip around and sign so that people pay higher prices for bonds and interest rates are lower. That's the premium that traders are willing to pay to buy this insurance against disaster risk, for lack of a better word. So I had been interpreting low interest rates earlier this year and late last year on long-term bonds, partly in that light, as evidence that this risk of a severe deflationary recession was a real one. And I had thought about the run-up in interest rates on long-term bonds that we've seen more recently over the last 3 months as evidence, is kind of good news, as evidence that that risk has been fading as the economy has begun to recover and monetary policy conditions have been more supportive of that recovery. Now, I wouldn't be willing to fight to the death over my interpretation versus the FOMC's, but on the other hand, in a way, that's exactly the point. Like Milton Friedman said, it can be really tricky business to focus on interest rates as indicators of monetary policy. Higher interest rates sometimes mean monetary policy is becoming more accommodative. Sometimes it can mean that monetary policy is becoming tighter. It's hard to tell the difference. That's why Milton Friedman focused instead on money supply and money demand, and that's why I like to too. So taking a look at monetary conditions through the quantity theoretic lens and focusing on money supply and money demand adds to the consensus, at least as it stood as of the beginning of this week, the consensus that says monetary policy is fairly accommodative right now. It's time to start thinking about an exit strategy and rolling one out. But what I would add to the consensus is this idea of focusing on the behavior of the monetary aggregates once again as indicators of monetary policy. If, as an exit gets rolled out and begins to proceed, we were to see a market uptick in the rate of money growth going forward, I take that as a serious warning sign that the Fed is falling behind the curve, risking an uptick later on in inflation itself. On the other hand, if we start seeing a decline in money growth again, like in 2010, I'd also take that seriously as a sign that the exit is rushed or premature, and a sign that the Federal Reserve would have to do something more to continue providing more monetary support.
Thank you. Okay, we have a couple of questions. Okay, there's somebody back there.
Policy conceivably be described as tight when they're buying $1 trillion a year of bonds and it's going into excess reserves? I mean, it isn't. That's by definition the loosest possible monetary policy. It isn't the better view that once the excess reserves started building up, what's occurring is there's nothing that monetary policy can contribute to this situation except to bake into the pie a gigantic future inflation that's going to spring upon us, and nobody's going to be able to do anything about it.
Right. That's a superb point, and I would answer it in two different ways. The first way would just be in terms of money supply and money demand, or in this case, the demand and the supply of reserves. What you pointed out about excess reserves, and I think earlier about interest on reserves, is that demand for bank reserves has gone up enormously, and that has to do with another aspect of Federal Reserve policy. The Fed is paying interest on reserves at a rate that's higher than the rate that banks can get on comparable assets, like just holding treasuries. So a lot of the increase in the supply of reserves brought about by quantitative easing, I think, has just, in the short term at least, accommodated an equally enormous increase in the demand for reserves. But I take your point. In the longer run, it's a risky strategy, because what happens if the demand for reserves begins shifting back to the right? But what your comment speaks to, and I think this also goes to what Mickey was saying earlier, I was a sort of reluctant supporter of QE all along, because I like to think about QE as like open market operations. You buy bonds to increase reserves, increase the monetary base, increase the money stock, and get nominal variables growing again. But the Federal Reserve is trying to do so much at the same time along so many different dimensions. The best way of putting it, and I think maybe this is what you're getting at the end, the whole meta design of Federal Reserve policy these days is no longer really directed at controlling nominal variables. And controlling nominal variables, like you say, has to be the first order of business for the Fed and any other central bank. So I say right on.
Just briefly a comment on how, following up what Peter is saying. I think you need I agree with what was said, but I also think the main impact that the Fed is having on the economy now is not monetary, not liquidity. It's on the fact that the Fed is taking on massive interest rate risk on its balance sheet. It's a fiscal policy that's having its main effect in sort of off budget. The Fed is buying long-term securities against overnight finance with overnight reserve creation, which will have to be financed in the future unless those reserves are drained, meaning that treasuries will have to be sold from the Fed's portfolio. So it's a pure interest rate risk policy and credit risk absorption policy, because the Fed is buying enormous volumes of mortgage-backed securities. So you have to regard whatever effect the Fed is doing now as a pure fiscal policy play. And that's how you reconcile what Peter is saying with what I think people think in the room. Well, there's some positive effect about what the Fed is doing.
Okay. Wait. Okay.
Could you talk about how you decide which monetary aggregates to use? I know that's like a large part of the problem, and I think people often dismiss sort of monetary targets because they say, oh, we don't know what to use, and there are these new divisive things which look great, but I wonder if you could talk about that a little.
Yeah, that's an excellent point, too. And it leads me just to add one additional note to my comments, which is that I wouldn't necessarily advocate, in fact, I don't advocate a return to what the Fed did or what the Fed said it was doing back in the 1970s and 1980s of actually announcing intermediate targets for money growth and then, acting as if those are targets to be hit, on an in-between meeting basis. Instead, I view money growth as an indicator of monetary policy that you might, a statistic that you might look at as opposed to, say, unemployment, to get a feel for whether monetary policy conditions are too accommodative, just right, or too tight. Now, fortunately, and this is part of the reason why I had the 4-panel graph, I mean, lately the monetary aggregates have kind of spoken in one voice. There are differences between various measures on a kind of month-to-month basis, but these overall trends towards, decelerating monetary growth 2005 to 2008, a bump up then and a bump up back down and then back up to what look like healthier levels, they're shared by all of the monetary aggregates. So when you look at that, that just enhances your confidence in the message that those signals are sending.
Okay.
Okay.
Yeah, thank you. Marvin? Our last speaker is Marvin.
Thanks, Mike. I'm going to talk about the chair's succession and the Fed's future. So, the public's interest in the Fed chair's succession is now on the par with, or perhaps even more intense than, the public's interest in the appointment of the Chief Justice of the U.S. Supreme Court. A public and Congress capable of consideration of broad constitutional and legal questions with regard to the Supreme Court is certainly capable of the same with regard to governance of the independent Federal Reserve. Yet the wealth of commentary in the media has focused on personality, style, gender, and has been sorely lacking in substantive content. I would love to elaborate on these points, but I don't have the time. You can read my summary of some of the arguments have been made in the past 3 months about who should be Fed chairman. It would be far more helpful to view the forthcoming Senate confirmation process for the Fed chair as an opportunity to reconsider the appropriate boundaries of Federal Reserve's operational policies in the way that the debate about Supreme Court justices revolves around the expansiveness of the Supreme Court or not, the deference the Supreme Court should pay to other political institutions or not. And that's where my thinking is going on this. So I would like to enliven and make more substantive the debates about who should be Fed chair based on the boundaries of what the Fed operations should be doing or not doing. The chair has the decisive say in whether the Fed should utilize broad operational means or narrow operational means to achieve its objectives, precisely because the Fed is so independent in the form of legislation. The chair's judgment establishes operational boundaries between the Fed and the markets on one hand, and between the Fed and the fiscal authorities on the other, Congress and the Treasury. The chair's succession matters hugely for how the Fed will act in the future, and I really wish that the confirmation process would bring these questions to the fore. The primary consideration in appraising the appropriate boundary for the Federal Reserve's independent operational policies is the distinction between monetary policy, which I will define in a minute narrowly as I think it ought to be defined, and what I will call credit policy. The Federal Reserve has never sought to make this distinction in public, which I think is a travesty. They call everything they do monetary policy, so that you can't have a coherent discussion about the boundary at all. So I would love the word boundary to be mentioned by somebody in the following way in the confirmation hearings. Monetary policy, narrowly defined, involves Fed operations that expand or contract bank reserves by the purchase or sale of Treasury securities from the Fed's portfolio, as Milton Friedman would describe it. Monetary policy works via the management of bank reserves and interest on reserves to influence the general level of interest rates and inflation. Monetary policy doesn't favor one sector of the economy or the other. That's one of the key attributes of policy for an independent central bank. And monetary policy does not involve taking credit risk onto the Fed's balance sheet, because the Fed can do monetary policy with treasuries only. In fact, when I got to the Fed 30 years ago, somebody walked me around and said, hey, we do a treasuries only policy. I was young, I had no idea what he meant, but I had it in my head all along. It finally meant something 5 years ago. Has it been brought up much since? Not really. So, monetary policy with a treasuries-only asset acquisition policy followed by the Fed before the crisis is well suited for delegation by Congress to the independent central bank. In contrast, Fed credit policy has little effect on the general level of interest rates and none on inflation. Credit policy involves Fed lending to private entities, financed by the sale of treasuries from the Fed's portfolio or by freshly created bank reserves. Fed credit policy essentially exploits the government's creditworthiness, by which I mean the sale of treasury debt against future taxes, to finance loans to distressed, or you might say favored, borrowers. Fed credit policy is really debt-financed fiscal policy carried out by the central bank. Except for occasional short-term Fed lending to regulated depositories on good collateral, the presumption should be that credit policy ought to respect congressional appropriations and be handled by Congress and the Treasury and not the independent Fed. That's the principle. The lack of clarity in the boundary of the Fed's credit policies, especially evident in 2007-8, is its aftermath, I might add, with the QE 1, 2, and 3, threatens the legitimacy of both independent Fed and the fiscal authorities. I use the word legitimacy even though it's an old-fashioned political philosophy term. What legitimacy is all about is, for how long will the public go along with this process without beginning to distrust the authorities to such a degree that the ability of the country to hold itself together politically becomes to disintegrate? I'm not saying this is imminent, but when you blur the distinction between the fiscal policies carried out by the independent Fed and by the duly constituted congressional authorities, you're moving in that direction. The absence of clear limits on Fed credit policy created another problem. Due to the tendency for Fed last resort lending to expand in reach and scope with increasingly distortionary and destabilizing consequences. What do I mean by that? In the 2007 and 2008 credit turmoil, the Fed was put in a no-win situation given its wide powers to lend. Disappoint expectations of accommodation and risk financial collapse, or take on expansive, underpriced credit risk, as Paul Volcker beautifully put it in a famous speech in April 2008, quote, with the implied promise of similar actions in times of future turmoil, unquote. The Fed chose the latter course of action, even allowing two major investment banks, not previously regulated or supervised by the Fed, to quickly become bank holding companies in order to access the Fed discount window. Now, in the 19th century, when the idea of lender of last resort was first talked about, Walter Bagehot classically said, quote, lend freely at a high rate on good collateral. The Bank of England and I'm glad Marvin is in the room. I hope I got this right. I don't know. I'm a little nervous. The Bank of England did not take on credit risk because the bank was a private profit-maximizing institution whose shareholders earned the profit and bore the risk of loss. The bank provided currency against essentially bankers' acceptances, which were risk-free because they had 4 or 5 endorsements on them against trade in process. So in the Bank of England, lender of last resort policy was really not credit policy. It was monetary policy. They got the language wrong, but in modern terms, that's what it was. What about the Fed? The Fed is inclined to take on underpriced credit risk precisely because it worries that not doing so would threaten the financial crisis, and the Fed's own funds are not at stake. The Fed is a public institution. The fiscal authorities receive net Fed income after operating expenses, and taxpayers implicitly bear any losses. Moreover, and next point is important, the Fed takes good collateral most of the time. But even when the Fed protects itself by taking good collateral, the Fed harms taxpayers if the entity to which the Fed lends fails with the Fed loan outstanding. Why? Because in this case, the Fed takes collateral at the expense of taxpayers exposed to losses from deposit insurance or other federal guarantees that might be in place. In so doing, Fed lending delays the closure of insolvent institutions, and my point here is very simple. Fully independent Fed last resort lending facilitates laxity and moral hazard, and there's no way to read the evidence over the last century that that's been happening. If you think 2007, 2008 is the last time we're going to see this, I think I'd like to place a bet. So where do I want to conclude? In light of the above-mentioned realities, in my view, the Senate confirmation process should ascertain the nominated Fed chair's inclination. The nominated Fed chair's inclination, because that's what we have to hang our hat on here, toward broad or narrow use of the Fed's operational credit policy independence. Senators could then choose to confirm or not, in part based on their comfort with the nominee's inclinations in this regard. To me, this is the kind of substance that ought to be part of our confirmation hearings for whoever is nominated to succeed Ben Bernanke, and I would very much like to see that take place. We at the Shadow Open Market Committee have agreed that this would be our joint statement or something along these lines this time, and I'll stop there.
Marvin.
Marvin, I have to be very careful what I say. Is this working? But I cannot resist regretting the fact that you weren't commentating in the UK over the past 6 years, Marvin. So I thought I'd make one comment on this, which is I argued very strongly that the Bank of England should worry about legitimacy, was the word I used, and that we should not go beyond the boundary of what were central banking operations. Now, what was interesting about this was that not one other person in the UK agreed with this. None of my colleagues seemed to be enthusiastic about having limitations on what the bank should do, because all good economists know that optimal policy, forget institutional boundaries, let's do what's needed for the country. The media were unhappy because they thought we should be buying any assets that might help, irrespective of credit risk. And most importantly of all, although I agree absolutely with you that these issues should be left to Congress here and to Parliament in Britain, it was the parliamentarians and the politicians who objected to my putting limits on what the bank would do. And I would say the single biggest source of criticism that I faced from politicians was a lack of willingness to do what I said was their responsibility. And of course it made them absolutely furious because they wanted to pretend that it was the central bank's responsibility because ex post they didn't want to take the responsibility or the blame if there were credit losses. And their strategy was to ask someone else to do that. Now, I don't know how you get around it, but I will be amazed if people in Congress would actually want a Fed chairman to put too many limits on what the Fed would do if they could anticipate that down the road they would actually want a Fed chairman to do it while they could then retain the freedom ex post to criticize the Fed chairman for doing exactly that.
Should I respond, or should we take more questions? I will respond in a minute. Let's take another question first. There's somebody way back here, too, who had his hand up a while ago.
Right, back there.
Well, I guess you have the mic, so you should.
Yeah, go ahead. Now, it seemed to me as an observation that all of these reviews at the Shadow Banking Committee ought to be focused on reviewing shadow banking and its activity, and that we're constantly living in a world of denial of pre-Glass-Steagall and post-Glass-Steagall and what people's functions are. And to your point of the boundary of the Fed being created in a pre-Glass-Steagall environment and not having the ability to roam, and when you don't review collateralized based credit extension, and you don't review off-balance sheet items that are basically investment banking functions that have been allowed to be brought into the commercial bank arena, you have some very, very difficult problems of measurement, particularly when you're relying on the past for going to macro approaches, because the comparisons are just not valid. They don't apply. So I would think that the focus of this committee, there seems to be a complete denial both on the presentations, on the part of the Federal Reserve, on the presentations as a part of our reviewing and shadow banking of this existence of collateral-based credit extension, which is more than half of what we're looking at. Okay, so I would love to have some comments on that.
Sure. I can give you a paper I have on exactly that subject. I'm sure people on the SOMC have written on it. No question about it. The money markets, what we used to call money markets, provided the financial fuel for this credit turmoil and this boom and bust. And we need to get back to kind of roping in those markets, because they really are involved with kind of moneyness, monetary, essentially assets which are close near monies that need to be dealt with, just like we deal with banking ordinarily. So I completely agree. We'll come back at the end and we'll talk to you about the papers we've written. And we will take that subject on again in the future.
In your paper, you make a comparison of the confirmation of the chair of the Fed to the confirmation of a Supreme Court justice. And I wonder if you might expound on that, because there's a very different process. A Supreme Court justice has a lifetime term. A Federal Reserve chair does not. But a Federal Reserve chair, if the definition of qualification is inclination, whether you incline towards, might have a confirmation process similar to a Supreme Court justice, in the sense that they will tell you what you want to hear. So my question to you is, therefore, is it really apt to have such a comparison between the chair and the Supreme Court justice? And what do you believe are the minimum qualifications for the chair? Because in a public process, the only time the public gets to inform that process of a section of a federal chair, if one meets the maximum qualifications for federal chair, why not other qualifications or criteria such as gender or race?
So first of all, to take your comment in reverse order, I'm not commenting on the personality, style, or gender. I'm going to leave that to others. I'm not qualified. What I am qualified, especially with a comparative advantage to do, is to comment on other criteria, namely, what does one think ought to be the boundary of the operational use of the Fed's independent powers? That's what I'm doing, is saying we want to bring that up. I'm not knocking other people's approaches to this. The second thing is, you're right. The Supreme Court justice is nominated for life, and so there's, in that sense, more at stake in these confirmations. However, the Federal Reserve is operating in a much, and also the Supreme Court, I might add, has consequences that are of much long-lasting. They're not immediate. The Federal Reserve is operating in a much narrower time frame, which I think kind of compensates to some degree for the fact that they're not appointed by life. In other words, the Federal Reserve can do a huge amount of damage in the next. Greenspan was not there for life, but he was there 18 years. So for me, that's a distinction that doesn't matter much. That's basically 2 business cycles in business cycle time ordinarily. So that's how I would approach good comments, but that's what I would say in response. On the substance, I do believe, and I'll stick to my guns here, that there is an issue of potential expansiveness or narrowness of the jurisdiction of these two institutions. That's where the debate is, and I think that's also a pretty good analogy. So I'll stop there, and I want to come back to what Marvin said. Yeah, it's kind of, I recognize this is an uphill fight, but I'm hoping, I mean, all we can do in the SOMC is hope that we can appeal to the better judgment of people in the Congress who understand what's at stake here. And to the public, I might add. It's interesting, you know, there's a history of the Fed fighting for its independence in the Congress after World War II to get back the power of interest rate policy, as you well know, over inflation, irrespective of the fiscal costs of the Treasury. And in that debate, the appeal was over the heads of the politicians to the public, and it was successful because the public at large was made to understand the issues at stake and basically came down on the side of a Federal Reserve that should be empowered to stabilize the macroeconomy for the good of the public at large and not for the financing of the Treasury. And what we're asking here is something similar. For the good of the country, for the good of the legitimacy of our government, for the confidence that the public can continue to have in how the government does fiscal affairs, it's imperative that the Congress take responsibility for most of what we would call credit policy. And that's all I can say. I mean, I admit it's a little bit naive, but one of the reasons we all devote so much time to this shadow open market committee is because we believe that good ideas will win out in the end. And I think your comments are beautiful because they express how difficult this will be in the United States. Yeah, so Mickey is suggesting we have, I don't know how much time. 10 minutes. We have 10 minutes for general questions to any of us here before we break for lunch and we hear Esther George speak. It's been a long morning, but yeah.
I'd like to ask you if you believe that I'd like to ask if you believe that the expansion of the regulatory role of the Federal Reserve compromises its independence.
I think the answer is essentially yes, but I would qualify that with the following. If the government insists that the Federal Reserve should lend widely around the country, and if the government or the Federal Reserve officials insist the Fed should have an expansive view of its purview, then you need to have some supervision of those parts of the economy that you are taking responsibility for. So the two, in my view, go hand in hand. And since I personally think, I'm speaking for the open market, that's a bad bet, you should shrink both back.
Can I say
sure,
a word about
sure.
that? You know, I very much think that it's a problem. And what's so interesting, let's just note the fact. As of 2006, look around the world, in Britain, in Canada, Australia, Japan, the entire Eurozone, monetary policy authority and regulatory authority were separated or becoming more separate. And as of 2006, we had a report sitting on the desk of the Treasury Secretary of the United States, written by the Steele Committee, that was advocating the same change in the United States, where the Fed would have an authority for examination, but not for supervision and regulation, precisely on these grounds. It's a very thick report. It makes good reading. What then happened was we had the financial crisis. And the logic of that report and of the prior decisions sort of faded immediately. Now notice the ECB is going to be the banking regulator probably for the Eurozone, a function that was not envisioned for them originally either. I don't think this is a coincidence because, you know, as Marvin was pointing out earlier, during these kinds of crises, political capture of central banks is demonstrated to be extremely convenient. And so I think that the movement toward empowering central banks more for regulation is precisely because they are they're powerful, and that it's a very intentional goal to create particular policy outcomes. So I think this is a very problematic development, And it's one of, in my view, one of the main casualties of our institutions coming out of the financial crisis.
But also does it not create the circumstances where the Fed is going to be questioned not just about monetary policy, but about the effects of their regulation by differing committees in the Congress?
Exactly. So remember that,
Supervisors and
I've written about this a fair amount, and I have a book coming out, by the way, called Fragile by Design with Steve Haber at Stanford, and we talk about this a little bit in Chapter 8 of that book. The thing is that the Fed cares more about monetary policy than it does about regulatory policy, and it knows that it's at political risk all the time. And so people who have analyzed this question that you're posing have generally concluded that the Fed makes for a very reliably manipulated regulator because it cares more about monetary policy and it's subject to political pressure. So you can get the Fed to decide, for example, that real estate is not an asset because remember, under Gramm-Leach-Bliley, brokerage of assets is supposed to be something that's allowed. But why did the Fed decide that real estate brokerage, to make real estate brokerage competitive, to allow banks to get into it, we might, by the way, reduce from 6% brokerage fee, it might be 2%. Well, that's a terrible idea, apparently. I'm not sure why, but apparently it has something to do with the real estate lobby in Congress. So the Fed was very reliably opposed to allowing real estate to be considered an asset.
Mickey, did you want to say something?
I'm going to say something here, and my members of the Shadow Market Committee may disagree with me, but I think in the current political environment and economic environment, it's silly to say that all regulation is necessarily bad. But I think one of the problems we face is a consequence of the financial crisis, and then the headlong rush by all the regulatory bodies to regulate, having recognized in part some of the mistakes that were made. We've ended out with almost the worst of all worlds with Dodd-Frank. We deferred to the BIS for capital regulations without really clear and transparent definitions of assets and capital. And then I think what's happened is we've ended out with micromanagement, regulation through micromanagement. And so my realistic view is, the banking sector needs to be regulated, but we're going about it the wrong way. What we need to do is it should be led with rigorous and much higher than they are now capital adequacy requirements with clear definitions of assets, okay, with very stringent sanctions against banks that violate, and then under that umbrella get the Fed and the FDIC out of the business of micromanagement and micro-supervision. So rather than look at it as a black or white situation, I think we should say, okay, what is the proper way to regulate that that minimizes the deadweight burden on economic commerce?
Yeah. So, yeah.
For anybody on the committee, where do you think we are with respect to the so-called Greenspan doctrine on how to deal with asset bubbles, and should the Fed really be concerned with them, or is it a macro-prudential issue?
Did you like to?
Just state. So very quickly, I would say that that's really where the macro-prudential sort of authority and the FSOC, which the Fed will be very important within, if not dominating, is going to be coming to play. And I think, Greenspan was actually right in saying that monetary policy is a very poor tool for trying to also target cooling off these things, and that the Colombian experience I talked about sort of proves that. And so I think that what you're going to be seeing is the FSOC's whole mission is to try to implement this very wide-ranging policy, and I was trying to caution them that they might think about that a little bit differently. But it's still allowing them to, in circumstances like 2005 to 2007, to think that they might have a tool there if circumstances warranted it, extreme circumstances. So in some sense, I'm really arguing for something that would have given an Alan Greenspan, although he legally really did have this tool already, he could have increased capital requirements. But, you know, in terms of creating the expectation in the market that such a thing would happen under extreme circumstances and then following through on it, that was lacking. And I think that might be a positive coming out of this whole FSOC thing, although the FSOC's not operating under any limits or any other sort of rule-based thinking. So I'm very worried that it's going to end up being more this kind of you know, flow diagrams heading in all directions rather than clear rule-based policy.
Okay, Mickey says it's time for us to conclude, so he has a few comments.
Yeah, so that concludes these two sessions of the Shadow Open Market Committee.
I think it is clear how fortunate we are to believe in the power of ideas.
Supply the common sense and the fresh thinking of the Manhattan Institute.